Welcome to the Smart Sales Solutions podcast, where we learn to implement intelligent solutions in a complicated marketplace. With your host, Rich Rudnick.
Welcome, everyone, to the Smart Sales Solutions podcast. Today, I'm picking up from Getting Ready for Increase, where I discussed the real estate boom and the rebound train that's coming, how the will of the people and the entrepreneur will lead us back through real estate, and how people tend to move towards safe assets, or hard assets, during turbulent times. I'm your host, Rich Rudnick, and joining me today are two experts in their own field, and I'm really excited about introducing them to you. One is a client of mine, and one I am the client of the other. So I want to go ahead and start with Brian. So Brian Eastman, thanks for joining us today, Brian.
Absolutely glad to be here.
Yeah. So let me tell everyone a little bit about you. So Brian is principal and senior consultant at Safeguard Advisors LLC, based in Boulder, Colorado. Brian's personally worked with thousands of independent investors, and I'm one of those small ones over the years, and has a deep understanding not only of the tax framework that governs self-directed retirement plans, but how to actually use such a plan successfully in a variety of related real estate transaction types. So Brian has personal experience as well with his own portfolio. So he has used his self-directed plans for 15 years. He's participated in subdivision development, flipping properties, rental, lease options, trust deed financing, various types of property. So I was referred to Brian, and Brian navigated me through. I was a newbie at this, and I have to say, Brian, you bring a lot of patience and knowledge, and if you can take me through this, you can take anyone. That's just what I'm going to say right now, right? So thanks for your patience. I know you were answering a lot of questions that I asked multiple times over, so I appreciate that, and privileged to have you here today. So,
like I said, glad to be here. Glad to help contribute.
You bet. And then next up, Joshua Christensen. So Joshua is a client of mine, and he's principal and senior advisor of EQT Property Management, LLC. That's based in Albuquerque, New Mexico. 21 years of experience, and he's taken personally thousands of New Mexicans over the years to build their real estate dreams. So he's also a private investor himself. So like Brian, he has skin in the game personally, and he understands the many different nuances of real estate, from rentals, flips, the whole burr and multifamilies, lease options, to name a few. Brian founded EQT Property Management to solve the problem many investors face, which is true asset portfolio growth. And Joshua is a client of mine. And Joshua, I have to say, every time we meet, I learn more from you. And you really impress me just with, you know what you're talking about. You know your stuff. And that presentation you did with my family, just kind of explaining the ins and outs of investing in Albuquerque, was extremely helpful. We were actually talking about that nineplex with my son.
Good.
So he actually pended his property, and so we're
Did he really? Oh, that's great. Congratulations.
So we got that. So gentlemen, I'm holding to my prediction, and I need you to set me straight, but I'm holding my prediction that real estate, I believe, is going to rebound from where we are now. In fact, I'm seeing it in certain parts of the country. I think, as you know, I have clients across the U.S., and I'm feeling that pressure. We're seeing in some part of the country that it's already started, I believe. And I also really firmly believe that there's going to be a movement from the stock market to real estate. I mentioned that in Getting Ready for Increase, that people like to move to hard assets, that would be a portion of what I believe is the rebound. And then CNBC came out with an article last week that basically stated the same thing. I actually have it on our blog page, so everyone can take a look at that and read the article. But there was a survey done recently that I think 21% surveyed feel that mutual funds are the best long-term investment. And that's like the lowest percentage ever that it's been. And 35% say real estate investment is the best approach. And that's why you two are here, to help sort that out.
Yeah.
I also believe, and I did a podcast last year, Serving Seniors the Right Way, that we are going to see the greatest transference of wealth the world has seen in this decade as baby boomers. And I'm pretty sure, Brian, you and I are. I think, Joshua, you're a little behind us. You're a buster. But those born between 1946 and 64 are now getting to that age. I'm the youngest of the boomers. I was born in 64. But those that are, say, 65 to 75 especially, they're needing to make their moves for retirement. And what's too fresh in everyone's mind is the downturn from 10 years ago or more. And so with seeing volatility in the stock market and the equity they have in their home, I think there'll be some positioning out. I think we'll start seeing a sell-off sooner, actually, just because of this. We'll see. But I also feel there's a move, especially for those, and Brian, set me straight on any of this if I'm going astray, but I believe that those under 65 and maybe 55 to 65, or maybe even Joshua's age and earlier, who are maybe a little disconcerted with where the turbulence of the stock market are, want a way to move into real estate. The answer, I believe, is the self-directed IRA, and that's what we're here to talk about today. And so, first of all, Brian, set me straight. What's your take on the market and what's going on? Do you have a different position as I do? Fill me in. Let's hear what your thoughts are.
Well, I think in general terms, you're very much on. I was unfortunate enough to have been through this cycle in this business 10 years ago. And, we saw a lot of panic. And, of course, in that situation, bad real estate financial infrastructure was a big reason we had an economic downturn. That's entirely not the case. Real estate's on pretty sound footing. We have more demand than supply. We have a shortage of new construction. We have the demographic move that you're talking about. We have a few other demographic factors I would add to that would speak to geography, maybe something we'll chat about a little more later in the conversation. But there's a lot of movement towards people seeing real estate as just the investment that has the most security and possible for real just income growth over time, and we're seeing it. And I would agree with what you've said. We've throughout the 15 years we've been serving self-directed IRAs, always seen people in that just ahead of retirement to up in their 70s saying, hey, I did what I did. I had my corporate job, which that generation had their corporate jobs for 30 years and didn't really mess with their retirement plan. And then they moved out and said, oh, wow, I got this big 401k. What should I do with it? A ton of people said, yeah, I'm going to get some of that into some hard assets, real estate and other different types of things. But it's younger people as well. It's people in their late 30s, early 40s. You have to accumulate a little gas in the tank, so to speak, to go out and invest in real estate. But I think it's pretty clear to everybody that regardless of market cycles, the stock market itself and how we invest in it has been so gamed. And unless you're sitting right across the street from an exchange with supercomputers and physics PhD designed algorithms, you can't compete as an individual investor. And so taking an asset that you can understand and control like real estate works a lot better. And a lot of sharp young people are seeing that dynamic as well.
Yeah, that's so true. And it is exciting, actually, to see that younger generation having a greater interest, because sometimes you wonder where they're going with that. But I'm definitely seeing that too. So Joshua, what are your thoughts on what's happening? Do you agree with our positions? Anything you want to add? Anything you're seeing being the boot on the ground in your mind?
I completely disagree. We should run back to stocks immediately. No, actually, I actually agree with you. Just based on everything that we're watching and having gone through, I was a mortgage broker when everything crashed 10 years ago, and that was a terrible place to be, in the middle of the epicenter of that whole the wreckage and everything that we dealt with. But the market is very different today. We've got low interest rates, lower than we've seen in history. I mean, we just locked in a client today to buy their first house for 2.625 on a 30-year fixed rate mortgage, if you can imagine that. I mean, it's unbelievable how low the rates are right now. And they're based on people who actually qualify to buy homes. 10 years ago, you just had to have a pulse and a good credit score, but you actually have to not only have a pulse, you don't have to just be able to fog a mirror, but you need a reflection in a mirror also. So terms of how people are qualifying for loans is very, very different today, and that has a big impact on equity positions and things like that. Inventories are unbelievably low in the Albuquerque market right now. Just in Albuquerque alone for detached single-family homes, we've only got about 1,000 homes available, and there's like 1 million people in the MSA. Yeah. It's unbelievable how low inventory is. And then there's still a pent-up demand. Right. This whole coronavirus thing has locked people in their homes, and we're still selling houses. Our numbers, we still have the same number of active houses today as we did when we started the coronavirus 2 months ago, and houses have come on the market and houses have gone off the market. It hasn't really changed a whole lot. So there's a lot of things that are happening, and I think we are poised and we're in a position for real estate to actually lead us out of this recession versus leading us into it and what happened 10 years ago. So it's an amazing time. And I love the subject of the IRA, the self-directed IRA. I mean, we taught the 401k came up, and pensions have kind of gone by the wayside. We don't have those corporate jobs with the pensions anymore because the 401k kind of replaced that. And here we are 30 years later, and we're starting to realize that maybe the 401k wasn't the perfect answer.
Yeah.
And so now people are starting to shift and scramble. The question of whether or not Social Security is going to be around in the next 15, 20, 30 years, what's going to happen with that? So real estate, people are always going to need a home. It's a great place to invest.
Mm-hmm. I couldn't agree more. And what you described in your market is almost universal across the country. And I have clients in many markets across the country, larger, smaller, metro, right? Smaller town. It's almost identical. And that's why I feel like with that pent-up demand, and we will be coming back up, that it will be stronger than ever. And our problem is inventory. It'll be a problem for small business moving up to inventory, supply, staffing. That'll be their challenge. And I think for real estate, it'll be inventory. So Brian, briefly explain for us, what is the self-directed IRA? Pretend like you're starting over with me. Maybe that's not the best image for you, but take us from start, beginning, call to close, right? On how you work on how a self-directed works and all the steps.
You underestimate your expertise. The thing is with these retirement plans, and we figured this out a long time ago, most people move their retirement money once or twice in their whole life. Yeah. So all the language surrounding it is a complete foreign language. And so we get it. We're used to, what's the difference between a rollover and a transfer? And it's all basic mechanics. But no, so, at the ultimate bottom line level, a self-directed IRA is just an IRA with more choices. It's still a tax-sheltered vehicle. It's still a means to accumulate savings in a tax-favored way and deploy that savings into investments and compound the tax savings over time to mushroom your savings. No different than an IRA at Fidelity or Vanguard or, maybe it's a little structurally and administratively different, but in terms of tax concept, no different than your company 401k, except rather than being limited to investing in conventional stocks, bonds, and mutual funds, the plan configuration is different and allows for really almost anything. The IRS rules only prohibit investments in collectibles like artwork and jewelry and stamps and Beanie Babies and life insurance policies. So everything else is fair game. So that includes the stock market and other financial products, but also real estate, stock of privately held companies, precious metals, things like that. The business is dominated by real estate. It's the asset class that people know and understand and that drives more wealth creation than any other throughout history, and so that's a big driver of our business, and the ability to facilitate taking that tax sheltered retirement money and putting it into real estate in a variety of forms is what makes it unique. In terms of the structure and how it's different to achieve that, that's our role, is building a vehicle basically to put our clients fully in control of their funds and give them that flexibility to invest in anything the rules allow for. And of course, with that additional flexibility comes a need to understand a few basic rules of operations. When you're in the narrow box of the stock market, you can't break certain IRS rules around self-dealing and commingling personal funds and IRA funds and things like that. So there's a few things educationally that we need to help people with. But mostly it's just about building a different plan structure. We have a couple, but the primary one, what we set up in your case, is what we call a checkbook IRA. And it involves an IRA account with a specialty institution, a separate firm we use that holds and reports on the IRA. I like to call them Fidelity with different paperwork. Everything IRA is the same, but it's people pushing paper instead of computers doing stock trades. And then we take that IRA and have it make a single investment into a specially formed legal entity, an LLC or a trust, depending on a particular client's situation. We'll say LLC because that's the more common for our conversation today. And basically what we're doing is creating for our client their own private investment fund. Mm-hmm. And the reason we build that two-layered structure, that IRA-owned LLC, is so the client can be in full control. They hold the cash in an LLC bank account. It's the LLC with a layer of asset protection that's on title to whatever asset. Say they want to go buy a rental house. Well, the LLC is going to buy that rental house. The LLC is going to pay for all the acquisition and operations, buying the property taxes, insurance, repairs, whatnot. And then any income through rents over time or when that property is sold goes back into that LLC, back into the fund that the IRA owns, and that's all tax sheltered under the umbrella of the IRA. So that's the basic structure, is that what we call checkbook IRA or IRA-owned LLC, and it's by far the most efficient way to manage IRA money, as opposed to, say, just stopping at that first layer, the custodian, and having a third-party processor that has to sign every document and cut every check. That gets real old real fast.
Well, there's another step that you did that was really helpful for me, because we had kind of a start-stop. And originally, we were starting to head down the road of maybe a property in Tennessee. And then we kind of pulled back, and then it was to a property in South Carolina. But what was a value add for me was you were nationwide and kind of guided on that, but it was the LLC setup.
Yep.
So on that, right, setting up that for me, because we need that, and you putting that in place and as part of the package, I thought was great. I mean, it was a little bit of a one-stop shop, right? Connecting all the dots on that.
Oh yeah, it's got to be turnkey. You don't want to cobble all that stuff together yourself, and that's a big part of what we do is build that tool on the front end and just make it streamlined. We've done thousands and thousands of these in the 15 years we've been in business, so that's the it's always a little bit of juggling and a little bit of figuring out and configuring, but getting you control over the funds is crucial, and it's got to be done in the way that suits particular investors' needs.
And the other piece too that I would say that is a great value add is because you cover so many states, and I am going to bring this up later about investing nationwide and the benefits of that you have understandings of the different states, and you seem to have that right. Maybe I was catching you lucky. I don't know on the states that I was asking about, but you seem to have that knowledge right away, and that was really helpful from my perspective. Coming in to have somebody like you to guide through when it's like you said, which makes sense. People usually do this once. They usually don't go all back and unwind, right, and try it again. And they're usually going to take one or two IRAs and do it all in one shot. So that makes total sense. Makes me feel better too. So who's a good candidate? Is there a good candidate, and is there for this program? Are there some people maybe who shouldn't look at this as an option?
There's always a few. I mean, there's really three primary considerations. Firstly is just being aware of what you're doing. A lot of people it's not something that they put any focus or energy to. They throw money in a savings vehicle. They want somebody else to manage it for them. And if you don't know what you're doing, you can blow your money real fast, right? So you obviously, not everybody should tackle this. You should make sure you're educated on the types of investments, whether it's rental properties or, buying into a limited partnership with somebody who's putting together an apartment complex or doing some private lending or whatever. So, having some expertise in how you want to invest is critical. And then you got to have enough gas in the tank. This is just a bit of a structuring, a little bit of expense. We'll probably talk about that a little bit later. You don't just set this up, and put $50 in it, because how much real estate are you going to buy for $50, right? Whereas my son, he went and set up an E-Trade account with $300, right? Okay, you can do that. Well, it doesn't make sense here. Where people start depends on where they're at in their investment cycle and what they're planning to do and how long they're planning to use it. But you can start at $50,000-$60,000 in certain markets buying properties or doing lending or things like that, and that sort of threshold makes sense. And then people wouldn't necessarily look in the mirror and see this themselves, but we see it, and we kind of put a little more energy into working with the folks that we think are going to get it. But you have to get it. You have to understand this is a super powerful tool, but it takes all the extra flexibility and power that it creates takes a little responsibility. And if you're sort of a ready, fire, aim kind of guy, maybe this isn't the right tool for you, because there are IRS rules that can cost you big on the tax penalties. So somebody's got the focus to say, yes, I'm going to treat this as a vehicle, not just an account. I get people, I talk to them, and they look at themselves in the mirror and they go, you know what, I'm going to blow this up. I better not do it. Rare, but it is something to be aware of.
Well, it takes that self-discipline, because it does go into the checkbook, right? So, and you're the signer. So, you do have to. You have to be disciplined enough to see the full picture and look at the long game on it. Any other misperceptions? That was probably the biggest mistake I would think that people make. Probably, right? Is that you probably alluded to? Are there any other misperceptions that people have going into this? That you find that
there's a lot of times people may have, the internet's a dangerous place, and it's full of information, good, bad, and otherwise. And so there's a lot of people that we speak to that they've been to some guru seminar, or they've been on the internet and seeing stuff that I don't know where it came from, but they just have some idea that they can do something they can't. They want to, use their IRA to buy a house that their kid can live in while they're in college, which you can't do. Or, they've been told, oh, well, I can do X, Y, and Z, and I don't know where that came from. So it's rare, but there's stuff out there, and a lot of people. It's sort of a simple distinction that I make when I chat with people. I say it isn't, hey, I want to go invest in real estate, and here's a pile of money I can get my hands on that happens to be tax sheltered. It's, I've got this tax sheltered savings that today is in the stock market. That tax sheltered savings is going to get moved. I'm going to reallocate it, and I'm going to put that tax sheltered savings into real estate. But it's the IRA that's buying the real estate, not you with IRA money. If you get that little simple mental trick, it's pretty easy to stay on the right course.
Yeah, no, I think that's great. That's an excellent point. So walk us through the fees, the tax considerations, and so forth like that. So what's
sure. Yep. So fees, we have a couple different programs. They're configured just slightly different, but in the grand scheme of things, sort of average case, folks are going to be looking at somewhere between $1,400 and $1,800 for the setup of the whole vehicle and the first year. And that's our services, legal and advisory. It's the administrative services of the IRA. It's state filings and legal work done by our attorney and all that kind of stuff, as well as ongoing support. So somewhere in that range is pretty typical. And then the beauty is annual operating costs are very, very low. In most financial services models, everything is based on what you do with the plan. It's transactional. What's the dollar value of assets under management per transaction as you buy and sell things? All that goes away. We're building a structure that puts the client in control of that. So there's some administration. If you've got LLCs, they need to be re-registered with the state, depending on the state. There's some administrative costs with the reporting that's done by the IRA account custodian. But it can be anywhere from $125 to maybe $300 a year, depending on state. So very low annual cost, and it doesn't change. You set this up and you start off with $100,000 and you buy one property, and then you have a windfall and you buy 3-4 properties and you're working with $500,000. Your cost basis doesn't change. The structure is still the same structure.
Yeah. Yeah, no, and it was very well explained, and I was just double checking to see if the rates are lower now or something like that, right? That when you charge more.
Well, we have special prices for real estate agents in Bend.
Yeah.
They're living the good life. We know. We know. Yeah.
You got a little wizard up
I'm
there
just
that's
double
selling
checking
cheaper.
it. I've got your price sheet here. It's just everything's lining up. Just making sure on that.
Yeah.
No, that's good. And then, but here's what I find that's amazing, is that most people, when I bring this up, really have never heard of the self-directed IRA. They don't know about that it's around, how to use it, how to leverage it for real estate. In fact, and I hadn't mentioned this to you yet, I actually forwarded your information to two broker owners of mine who were talking about them setting up retirement accounts for them, partly because they're being enticed away their agents by other offices. And I said, well, let's one up that, threw that in there. Let's combine with the retirement plans, but help them, since they're in real estate, right, connect with self-directed. So they're interested in all that. But what's interesting is not many people know about this. It's like a big secret, yet it's probably not going to be as much of one either. So why is that? And maybe it's not as big of a secret as I think it is.
It's a pretty big secret. It's not nearly the secret it was back in 2005 when we started, believe me. But self-directed IRAs have been around since the 1970s. I mean, when Congress created IRA and 401k retirement plans in the 70s, there was nothing that said, oh, you must go work with Wall Street and invest in stocks, bonds, and mutual funds. Wall Street jumped right in and said, oh, we got this. And they took over. And they've got the marketing budget and they've got the tap into corporate HR departments, and frankly you're not going to set up a self-directed structured retirement plan at Boeing or Ford. It makes no sense. You wouldn't do it, right? So it's understandable why that's been the dominant paradigm. But people have been self-directing for years. When I first got into this business back in 2008, it was a lot of convincing people that this is real and it exists and all that. Now it's a different game. People who have stumbled into it because they're interested in alternative assets like real estate know a little bit, but it's just scope. And the word has, like I said, it's grown tenfold. We were one of about 3 companies in 2005. Yeah. There's probably 20 companies doing what we do now. So.
Yeah. But I think you're still in the early stages of your growth. You haven't hit max capacity at all. I don't think, and I want to turn that to you, Joshua, because it's my perception that it's not that now. No, now maybe it is more so in your circle, particularly. But I want to get your take on that. Why is this more known or less known? What's your thought on that?
I was telling Brian before we started the call, back in the this would have been in the late 90s. I was a personal banker at a bank, and people would come in and ask me if our IRAs were self-directed, and I said, sure, you can get a CD or a savings account. Which would you prefer? You get to choose.
Yeah.
And I didn't know any better, right? And they would tell me, well, can't we invest in real estate in our IRA? And I said, oh, no, you can't do that. We certainly don't have that product.
Yeah.
And it was, and I didn't have any idea who to send people to, right? And so, but it's amazing. You mentioned that in my circle, within the network of realtors, it's amazing how many realtors don't even know.
Right.
Because it's like what Brian alluded to. Wall Street, the banking industry, they have done an amazing job for the last 40 years, advertising, marketing, getting into big corporations and providing retirement plans for people. And so most people, when they think of a retirement plan, the only thing they think of is stocks and bonds. They don't think there are any other alternatives out there. And then they talk to their Aunt Sally, who lost a bunch of money in real estate, so they just don't even want to think about that. So there's a lot of nuances around it, and I think the capital gains is a big problem with real estate investing that this self-directed IRA kind of removes.
Yeah,
and it helps remove. I mean, all of a sudden the 1031 exchange goes away if your IRA is growing, and you can buy and sell your real estate inside that IRA all day long without having to worry about that because it grows. It grows in that vehicle. And you can correct me if I'm wrong, Brian, but I mean, I think the self-directed IRA solves the tax problem for the younger people. I think it solves the income problem for the older people, and it solves market volatility for everybody. I think a self-directed IRA it's a genius investment vehicle for real estate, and there's no cap on that growth within that portfolio, where there's a cap on your contributions that you can make into a typical IRA on an annual basis, just coming out of your income, if you're transferring from your personal into that IRA.
Yeah.
But once it's in there, there's no cap on the growth, and that's a beautiful, beautiful thing. So I think it's it really is still a secret. But as Brian said, I think one of the things that's getting it out there is the internet. We have a lot of people that are starting to teach more on real estate investing, and they're starting to talk more and more about where to find money for investing in real estate.
Yeah.
They're training would-be, wannabe investors that don't have any money where to find it. And they're telling them, go talk to your Aunt Sally. She's got money in her IRA. So it's getting out there more and more.
Yep. And I think there was two prongs to that approach. One was for realtors to utilize that because they have the inward track on inventory, right?
Yeah.
And the access to the inventory to purchase and transfer into. But the other is in educating their prospects, which is just where you were going, right? To help find the money, if you will, and provide those opportunities, especially with what's happening now. That gives the open door. People are looking, and where do we go? Well, here's the solutions. And so that's great. All right, so let's say we have a prospect, both of you, who is moved into his IRA into a self-directed and wants to buy real estate, but doesn't have enough. So they have cash for a large down payment. Now they need to get a loan, but it's not just any loan. So what's different with the IRA, you don't go to your bank and just get a conforming loan. You get a non-recourse loan. Not everyone does recourse loans. I also found out that interest rates are generally higher. They require a higher down payment. Kind of like you mentioned, Brian, it's not you or me buying the property, it's the LLC buying it. So everything is based on the property qualifying. So there's some pros and cons. I think there's some actual pros for the investor, right? Because there's usually safeguards and performance that the lender does to make sure the house will perform, and they're very safe and conservative, generally, at least the lender I spoke with. But I think there's some downsides too. So if you're going in on that, one of them could be that potentially longer market or escrow time may put you in a little weaker position. It just depends going in. So I want to hear from both of you. I'll start with Brian first. Just experience and take on that, how to work. And do you have referrals on lenders that do non-recourse?
Sure. Yeah. So the issue is that, again, it's not you buying the property, it's the IRA. And I talked a little bit, we're not going to go into details here today, but just you have to keep your IRA very, very separate from yourself. So you can't pledge a personal guarantee and pledge your assets as security for the IRA's debt. That would violate IRS rules and end up with a big tax bill that you wouldn't want to see. So it's, like you said, the property is qualifying for the loan. A handful of bankers that do that. There's about 4 national players. There's some local and regional players that I typically find aren't competitive with those national. And of the 4 national, really 2 have been doing it for 20 plus years and kind of dominate the space. But you're right. They because it's just really that property that they're looking at, that's their only security. They can't come after you for additional remedy in the event of a default. They're going to be a little more conservative. I haven't spoken to them since the coronavirus hit, but I'm getting some inklings from people I talk to and whatnot that their loan to values at this moment are even lower than they normally are. I owe it to myself to get on the phone. I usually talk with these guys 2-3 times a year. They're nice guys, and we serve the same people, so it's nice to know what page they're on and be able to educate folks. But typically it's 30 to 40% down, 10 to 15% cash on hand and reserves. Interest rates that are about a point to a point and a half higher than a loan that you could go out and get in your own name, an investor loan. I tell people forget all of that in terms of comparing it to what you could go get on your own loan, because it's a totally different thing.
Yeah.
What you want to realize is how much leverage are you using in your IRA today that's in the stock market? It's exactly one goose egg, zero. Nobody's using leverage in their IRA. So any leverage is a huge improvement and a huge game changer. And that's my key takeaway when you look at using leverage in an IRA, is you just set the right expectation of, wow, I get to bring leverage into this tax-sheltered vehicle. It isn't that fantastic.
Yeah.
Now, the other side of that is when the IRA borrows, it can accelerate its growth. You also complicate the administration of things just a little bit, because the IRA is now not just receiving income based on its own capital, but it's also receiving income that's derived from the non-IRA capital, the borrowed money, and that creates a small tax exposure. And I don't want to go into lots of nuts and bolts details today on that topic. We could have another podcast sometime if you want to, but the bottom line is there's a little bit of friction. You say you do a 60% finance deal, 60% of the income is taxable. You get to use 60% of all your normal deductions to offset taxable income. You're left with what for most investors on a $100,000 property might be $150, $200 worth of taxes at the end of the year. And yet you're getting a leveraged return that's probably increased your rate of return by 3, 4, 5 percentage points. So it's a non-issue, other than you got to know about it. You got to have a CPA in your team to help you work about it. So that's the little bit of the issue. And then, as you said, just to wrap up on your questions, going in originally and looking at financing and non-recourse, I don't know that it's a whole lot different than looking at a loan with conventional financing. I mean, you get a little more certainty from these non-recourse lenders on what they'll lend on, because they're portfolio lenders. They're lending their own money. They're not just originating notes that are getting sold off to hedge funds. So they're much more in control of the process. So I don't know that it's a whole lot different. It's obviously different than having the ability to write a cash offer. And I do see some clients who, maybe they've got, I'm just going to make up some numbers, $300,000 in their IRA. They want to go buy 3 properties, but they go buy a property all cash and go make a low offer, and then I can close quickly and get a more aggressive deal. And then they drop financing out of that property after the fact and liberate some of that capital to go do their next deal.
Okay.
So, there's ways to utilize those strategies intelligently.
Yeah, that's excellent, Joshua. So on your side, coming through with, have you dealt with somebody doing a non-recourse loan with the self-directed coming in on an offer state?
No, I haven't actually been on the receiving end of that. I've been on the borrowing end of it, where I had somebody that lent me money from their IRA.
Okay.
We utilized that, but I have not. I haven't been on the other receiving end of that, so I don't have a lot of experience with it. I'm familiar with the non-recourse loans and portfolio lenders and things like that. But Brian covered. I think Brian did a great job going into great detail on that. So there's not much I could add to that.
Good. Well, let's take the scenario now that Brian refers you a lead of somebody who has transferred his money as IRA into a self-directed and wants to invest in Albuquerque. And they're excited, but they're nervous. First-time investor.
Yeah.
And what's good for you, and I think you're great, an excellent value proposition, because part of the stipulation of the self-directed IRA is you cannot manage the property yourself, which is great for me. When I bought that property in South Carolina, I was going to do that anyway. I really wouldn't want to, right? But your value proposition is your start to finish, right? You'll help them acquire the property. You walk with them along the way. You're all about their asset portfolio growth. You're going to manage the property for them. So you're really vested, and that's excellent. So how does that process work? How are you going to help and educate? And they're remote, right? So they're coming in and needing to trust you. And how do you put that all together for them? How do you make it happen?
Yeah, I think so. If a referral's coming in from Brian, for example, in this scenario, first thing I would want to do is set up like a Zoom call or set up some kind of a conference with Brian and the client and I. That way, all the players that are involved in the transaction are we're all on the same page. We know what we're working with. We know how things need to be structured. And then I'm going to go ahead and start doing, I'm going to go through the interview process and our discovery process to find out what kind of assets are we looking at? What type of investments are we wanting to add into this portfolio? What are your goals? And Brian's going to kind of reveal some of that as well in our conversation. That way when I start doing my market research and I'm, I start looking for investable assets, then it's going to be very, very clear on what we're moving towards. So I become an acquisition partner for growing their retirement portfolio, essentially. I'm going to go through the due diligence with them, take if I'm working with somebody that Brian has referred to me, chances are they're not going to have their boots on the ground in town with me. So, I'm going to make sure that I'm there for inspections and walking through and talking with the various making sure that the asset we're buying is a solid asset, that we're not going to have a lot of deferred maintenance that we're going to have to deal with. And if there is a lot of deferred maintenance, okay, what's it going to take to bring this thing up to value? Or what are we going to have to pay to acquire this thing? Once we go through that whole process, everybody's happy with it, we go forward, then I'm going to go ahead and we're going to step into the portfolio management. We'll close on that transaction. We'll get into the portfolio management, which is going to include your daily operations. Of course, we have to maintain the cash flow and expenses and things like that. So we'll collect the rents and do the collections and all the, fix the toilets at 2:00 in the morning, all that fun stuff that goes along with owning real estate. But then we take it a step further and we start looking for ways to grow that asset, grow the value of the asset. Mm-hmm. We're gonna sit down with our partners and do quarterly reviews and make sure that those assets are performing well and that we are poised for growth. Mm-hmm. We want to grow that portfolio. I mean, we're talking about somebody's retirement, and so. And then we may come to a point where there may be some recommendations for liquidation and trade up, and, we may want to take this, maybe we start out with a 4-unit property. It was somebody's younger, has a little bit less to work with. So we might take that 4-unit property and we may want to trade that up to it's the old Monopoly game, right? It's 4 greenhouses for 1 red hotel.
Yeah.
So we start looking at liquidation trade-up scenarios and how that might work, because we're trying to grow a tax-free IRA for a long period of time. So this is a long-term process that we're gonna jump into. So
you bet. So we got this first-time investor. What are the common mistakes first-time investors make that you see?
They know everything.
Okay.
They already know it all. They've been on the internet and they've seen a video on YouTube and they went to a class and read a book, whatever. One of the big challenges, I appreciate what Brian was talking about a little while ago when we were talking about non-recourse loans and portfolio lenders and whatnot, that they are risk-based lenders. Well, this is great because one of the big mistakes that investors make is they try to over leverage and they want to get into properties with 0 down. Well, that's what got us in trouble 10 years ago. Mm-hmm. And we don't want to over leverage. We want our equity working for us, and we want to make sure that we maintain that. Our equity becomes kind of a buffer against market fluctuations. And so having a 30% down payment, 25, 30, 40% equity position in that asset, and having the 60%, 65% leverage, that's actually a really strong asset class, and it's gonna protect that for long term, because we're talking about especially in a self-directed IRA, we're talking about our retirement. We don't want to put this at risk. Mm-hmm. And it also gives us the ability to keep those payments lower, so that when we have market fluctuations right now, if rents dip for a little while, we've got the flexibility to be able to drop because maybe we're not over leveraged. Yeah. We can drop our rents and still be cash positive in those assets. Another problem that we see with new investors is that they overbuy. They don't really understand the market very well, so they end up buying things at retail prices. because they think, oh, it's okay, no problem. I can buy at retail price. They over leverage, and then their debt service and their management costs are more than the cash flow on the property. So they're actually having to make payments on that asset every month. Well, that's not a growth asset. That becomes a liability.
Yeah.
And so we don't want to be in that situation. Looking at properties that have zero cash flow, that's going to create some of those leverage issues. Having a one-dimensional view. Some people come in and they look at, oh, it has to make $500 a month after all the expenses and everything. Okay, that's great, but that's not always going to be the case. It can still be a really great view because they only see the cash flow as their profitability. They don't see the other 3, 4, 5 ways that those assets actually grow in value and how they grow in value. So, we want to walk people through that and educate them on that. They'll take a short view versus a long view, which becomes speculative. I'm going to buy this today. It's going to give me cash flow for a little while, and I'm going to sell it next year and make $1 million. Well, real estate's a long-term investment plan, especially when we're talking about our IRAs. It can be anywhere from 20, 30, 40 years to 5 or 10 years, but it's going to be a long view that we've got to take on these assets, and how is this going to play out over time?
Yeah, that's so good. So how about misperceptions, especially on the management side? Because technically, purchasing the property is the easy part, right? So that's easy. Yeah. Managing it is different. So, and I think the fortunate case, and you brought this up, and I think you did too, Brian, that there actually is a lot of protection when you go through that lending perspective on the heavy down, and they're going to perform the property and all that. So really for investors, it's really a good, safe place. And then you have to get a property manager, right? So that actually is really good. But what are just real quick, some misperceptions that investors make typically when they are out having to manage it themselves? To save the money, right?
Yeah, they want to save money. They don't want to pay somebody to do it. But a good property manager, a good portfolio manager, is going to be worth their weight in gold.
Oh yeah,
they're going to save you so much time and so much headache and heartache and whatnot. Your typical property manager, all they're out doing is collecting rent and they're performing maintenance. They're fixing toilets, But a good portfolio manager is going to partner with you're partnering with that portfolio to make sure that it performs.
Yeah.
And so not all property managers are created equal. So you really want to go through and make sure that we're not getting into bed with somebody that doesn't have the same view and doesn't have that same long view and goals with you, doesn't share that value match in what you're trying to accomplish. So property managers that set it and forget about it, you can do that yourself.
Right.
So,
right.
Yeah.
We're not all created equal, just like realtors or advisors, same thing. Now, so who would you encourage to invest and who would you discourage to invest?
I encourage everyone to invest, but not everybody should invest. It's kind of the same thing that Brian said. I think real estate is a fantastic asset class, but you're going to run into different stages of investing. You're looking at how much time does somebody have available to invest?
Yep.
Are they at the end of their career and they're going to need to start drawing down on their retirement? What kind of lifestyle do they want their portfolio to build for them? What are their goals? So we've got to kind of uncover all that stuff. Different asset classes have different results. Residential versus single family home, multifamily properties, small multifamily versus large multifamily. Are we looking at commercial properties? They all have different nuances that we have to kind of get into. So, like as Brian said, if you're not really aware of what you're getting into, you can get yourself in trouble really fast, and you can lose a lot of money really fast. So I don't think somebody should jump in just guns a-blazing. We're going to make all kinds of money. Those are the people that get hurt really fast.
Yeah.
So when people ask me where to start, the first thing I tell them, I said, you need to start reading some books. You need to start attending some classes. There's plenty of free classes. Watch videos online and find people that know what the heck they're doing that you can network with. Spend 3 or 4 years or, whatever it is to gain the knowledge. That is probably the best, most valuable tool that you can have is your knowledge. Because you don't know what you know, or you don't know what you don't know. And when you find out, it's expensive.
Yeah.
Those are some expensive lessons. So, just take the time and be patient. It's you got to have a strategy going into it. Are you going into it for cash flow? Are you going into it for equity buildup or capital raising? It's speculation versus fundamental investing. We've got to figure out what we're doing as we go into it. Not everybody's ready for that. Some people are way too impatient, and that'll just get them in trouble.
Yeah. Give us a quick pitch on why someone should look at or consider Albuquerque. What are the benefits?
It's Bugs Bunny made the left turn, right? Why else, So Albuquerque, we're actually an emerging market, and we're kind of at the beginning of the emerging market phase. We're seeing a lot of new job growth in various different sectors, from entertainment to technology, government buildup, satellites. So we've got, we just got the big studios over here in Netflix and CNBC. Facebook came into town recently. So there's a lot of great jobs. And where there's jobs, people have money. They also need places to live.
Yeah.
So there's some of them are going to be renting and some of them are going to be buying. So those are all good things that we're looking at. We've got a low concentration of lower income, affordable housing. So that's become a problem in Albuquerque. We're running into that low income housing or affordable housing sector that needs investors. They need homes. There's a low construction of multifamily homes, of some of the larger multifamily homes. We've noticed that some of the multifamily builders that have come in the last couple of years, they haven't built very much here, but what they have built was the higher end luxury homes, and our market hasn't quite caught up to them. So they've got higher vacancy rates than some of our lower or mid-level income properties that investors just want to take a swing for the fence and they miss out on some great opportunities in there. And we're a landlord friendly state.
Yeah.
So
that's rules. Good.
Yeah.
That's good. So I'm seeing that there's this trend of investing in other markets. So I'm in Oregon. I buy in South Carolina. We're looking at hearing what you had to say, Joshua. And I think that's for various reasons. There's some markets where it's priced out, right? High priced West Coast markets, for example, or Northeast. And people can have their money go further in other areas. The numbers are better. And so, Brian, you work the whole country. We heard about Albuquerque. Do you have some guidance on that? Like if somebody's looking and they want to go elsewhere, and I'm going to bring the question back about the team. So, Joshua, you're going to help answer that one in just a minute, but just other locations. So Albuquerque's one. I'll say Lawrence, South Carolina. That South Carolina Southeast Belt is one. By the way, I want to just bring that comment in too, because you were alluding to that, Brian, that we're going to see demographic shifts, right? Mm-hmm. So, and we're going to see geographic shifts. We're going to see people moving, which they've been anyway, from the Northeast to the Southeast. We're going to see that accelerate, I believe, once everything gets lifted. In fact, there was news articles on that. We see people moving out of California into Arizona, Nevada, up to Oregon and Washington. Not as much anymore, but that's still a play. And then into areas of Idaho. So we're seeing all of this geographic movement too. But any other areas or suggestions or things to look for in areas?
Yeah, I mean, I'm seeing, a lot of different stuff. And, to be clear, we don't recommend specific investments or offer investments. We give, clients control over their funds and just help them vet what they're looking to do and make sure they're doing things the right way. But I work with thousands of clients doing all kinds of deals all across the country. There's a handful of markets that really stand out. Indianapolis, probably at the top of the chart. We, for many, many years, seen a lot of really strong stuff in Texas. I'm afraid that's probably going to start slowing down with the hit that the energy industry is taking at the same time as what we're seeing here. So maybe going to be a little less positivity there. But all these secondary markets, Albuquerque, a little off a lot of people's radar screens, but it's, for all the reasons that Josh was talking about with the diverse economy. Des Moines, there's a couple cities in Michigan, not in the Detroit area, but like Grand Rapids, these sort of mid-size, maybe college towns or places where there is a more dynamic job space, but those smaller cities that are affordable, especially with millennials and the renting population. If you're looking to be an investor, the cash flow is where the kid's moving. Well, hey, 20 years ago, I did what people have been doing for years and what we're really seeing a lot of now. I moved out of San Francisco to Portland, Oregon. You know why? Because it cost half as much.
Yeah.
Right? Well, people are now moving out of Portland, Oregon to, places like Boise, and even Boise is starting to get a little more expensive. Boise is another good market I would mention. Salt Lake is real strong. Ton of stuff in the southeast. But the key is, regardless of the market, it's the neighborhood and it's the team. Assets are assets.
Yep.
But what makes especially long distance real estate perform is having the right asset manager. And Josh alluded to it, and I'm going to say there's a very clear distinction between a property manager and an asset manager.
Yeah.
And I've done all of it. I've invested and managed properties myself locally. I've invested at long distance with quality property managers. I've invested at long distance with not so quality property managers. Well, I started out with a really good property manager. I did my homework. She retired, and then I was in a problem in that market. But having the right property manager makes all the difference. And I'd say that's even almost more important than which market. There's a lot of markets that are going to have the same sort of fundamental underlying dynamics. One I forgot to mention also is Memphis. It's the hub of the digital economy. It's the shipping hub for Amazon and everybody else, right? So lots of good cities, but it's finding the right partner that's going to take care of you and make sure you're getting the most out of the assets that you're putting your money into.
So that goes to the question now to Joshua. So tell us about the team. So you need a boot on the ground, you're remote. Obviously, we need that realtor. We need that asset manager. You get a 2 for if you go to Albuquerque. But what else? What are the key team boots on the ground that you need, team players?
Well, I think obviously you've got the broker that's going to help you with your acquisition and liquidation. You need your portfolio manager, and I think the portfolio manager and your community manager may be the same person, or they may not be. But your portfolio manager is going to be focused on the growth of your portfolio, while the community manager is going to be managing the daily operations of that property and kind of doing that. So that's part of what we're building, is to make sure that we've got people that are focused on the community and the residents, as well as the somebody that's focused on growing that asset base and that portfolio base. You got to have a strong maintenance team and contractors that are going to take care of your make-readies, take care of the landscaping, carpet, all those types of things, and have those contractors. And your portfolio manager and property manager should have all of those contacts in place. They should already have some good people in place for that. Of course, you definitely want to make sure that you've got a good CPA that is handling your, making sure that you're protecting all your assets for tax purposes, because your chances are you're going to have some assets that are inside your IRA, and so you've got different tax issues going on with that versus any of your assets that are outside of an IRA that you hold personally or in an LLC or something like that. So you want to make sure that you're covering all your bases with your tax advisor. And I always tell people with their CPA, ask them if they invest themselves. If they don't invest themselves, they'll probably tell you yes, they do real estate investing. But if they don't do their own investments, they probably haven't spent the hours combing through the tax code to know every little nuance of what's legal and how they can save money. They just throw taxes together for their clients who happen to have real estate. So there's a big difference there in how they handle that. So those are the big players that I would say that you want on your team. And then of course, if you're working with IRA money, then you got to have somebody like Brian who's going to handle, make sure that IRA is being handled properly, and that you're not getting yourself in trouble with taxes that could cost you a lot of money on the backside.
As you get there. Well, listen, guys, this has been great. I've learned so much, and I want to thank you both for sharing your wisdom and your expertise. And I'd love to keep rolling, but we do need to wrap it up. Let's do this again, and we'll come and do this soon. So thank you both for joining me. Any just last parting comments? Just any wrap-up thoughts, either of you?
Enjoyed being here. Always happy to contribute. And I mean, this is the conversation investors need to be happening. We're at a watershed moment, and a lot of people panicked. Their 401k became a 201k. I like to joke, which is not really funny, but it sounds funny, right? And people need to really rethink, how am I structuring my investments to create the maximum balance of security and growth. Nothing does it like real estate. Nothing.
That's right.
So true. That's a great way to end it. Well, thank you all for listening. Go to smartsalessolutions.com. Go to the bottom of the page and click on the link. Will real estate boom as investors seek hard assets? You'll find the bios and more information on Brian and Joshua. You'll find the link of the CNBC article. Let us know how we can help you build your wealth as well. Thank you so much for listening, and have a great day.
Thank you for listening to this episode of the Smart Sales Solutions podcast. For more information, go to smartsalessolutions.com.